Okay, let's get started. Hey everybody, thank you for viewing this. If you're a current investor or a new investor, or just interested in seeing what we have to offer when it comes to our latest offering, we're really grateful that you're here. Today we're going to do a deeper dive into the Bloomington Collection offering. But before we jump into that, I'm going to pass the time over to our founder and principal, Chad Sheeler. He's going to give you a little bit more background on who we are as people and as a company, and then give you a little bit of the exciting backstory of why we chose this deal and how we chose this deal.
Hey, thanks, Jared. Appreciate that. Well, welcome, guys, to this opportunity review of the Bloomington Collection. We're very excited about this one in particular. More about Focus Capital. We're very selective on our process and our criteria here. As a matter of fact, since our last acquisition, we looked at over 160 deals that are buy box. Now we found two combined, that have fit our criteria that we're allowed to acquire. Is a lot of numbers here we have to go over to find the right deal. A lot of offers out there, but this story is very unique to where we've found an opportunity. We're really creating an opportunity to where a lot of other groups couldn't make it work. We've combined one property that was on market with a property next to it that's off market. Because we know both sellers independently, because of our relationships, we're able to combine both into two, which Jared will go into more later on. But that creates a unique opportunity for us to have a more scale opportunity to offer to you as investors. So without further ado, I'll pass that off to Jared and Chad here. Thank you so much.
And as I'm about to share a new deck, I also want to give an introduction. Chad Olson, who's our VP of Investments, he does a lot of our underwriting, our deal review, a lot of the analytical side of our business when it comes to a deal selection. Everything that we have invested in and will invest in has come through his desk. Chad is also on here, and he'll help us with today's presentation. We're going to start off with our executive summary. So the Bloomington Collection is a unified acquisition of two adjacent stabilized workforce housing communities. 132 units in total, and as Chad Sheeler had said earlier in this video, it was really unique because both properties sit on the same street and serve the same tenant profile. But part of our business plan as we bring them in is we're going to be operating them as a single institutional quality platform from day one. Our acquisition price is $14.7 million. That's approximately $111,000 per unit, which is significantly below the replacement cost of $160 to $180 per unit. So that means if we were to build / develop, we are acquiring an already existing property for less than we would have to build. The in-place rents are average around just over $1,100 against a current market of closer to $1,300. And that $190+ rent gap is not a distress story. It's the product of a little bit of asset management, operational management, and some things that we're looking to improve. And those are our primary drivers there. For anyone familiar with the Bloomington, Indiana area, there's a major university down there, Indiana University Bloomington. They have just under 50,000 students in this recent enrollment, have over $1 billion in annual research expenditures, and they have a direct workforce of approximately 13,000 plus. So they function as a permanent demand floor for the workforce rental housing market in the area, and there's no new conventional supply that is approved during our whole time. Quick high level numbers before we jump into Chad Olson's side of things. We're offering approximately a $5 million raise with a $200,000 minimum investment. Our projected LP IRR is 16.8%. Our equity multiple is just below 2.1%. And our average cash on cash return over a 5-year hold is just over 6%. So I'll walk through those returns in detail a little bit later, but I'll hand it to Chad Olson to kind of take us through the asset itself, talk a little bit more about the background and some of the other unique features of this asset.
For sure. Thank you. Yep. So kind of Chad Sheeler talked about it a little bit as well, but we came across this one as Hazelbriar was the deal that was trading on market. And with it being 70 units or so is somewhat on the smaller side. You know, when we want to see those management efficiencies that we're looking to gather, that's usually 100 units and above that we find that in. And so the conversation, you know, naturally began with the broker, like, hey, we think this is a good deal, is really good for you guys. And there's a chance that we can maybe make something happen with this deal next door that's similar vintage 1990s, which is definitely in our target criteria. And then get us that scale that we're looking for. And this is kind of a typical roll-up strategy that some people will like to execute and can find when the opportunity presents itself, where you find either what's called a scattered site, or if there's properties that run adjacent to each other that are smaller in size, molding them together to make a larger portfolio, where then suddenly you can bring in in-house management team that can take care of just those properties at 130 units. And so we were finally presented with that between these two and bringing them together, that these two owners kind of ran separately. And they, you know, one owner does have some presence in Bloomington that allows them to do that, but the other one didn't. And that's where we've seen the opportunity from one to the next. Like, hey, this one's got a little bit higher rents. This one has some better other income drivers and expense loads. And then, you know, basically providing the synergies of the two and getting us a presence in the market. And then being on the south side, it is removed from the student population. And so that's actually a good thing when it comes to different lenders and agency underwriting. They can sometimes penalize a deal and do a little bit different underwriting standards that are a little tighter than what we would get normally. And so this is truly like a workforce housing. And we'll see some grad students or law students that are going to the university that would stay here, being a little bit more removed from the campus life. And I think that's another big driver that we see and why we like the opportunity. Hazelbriar itself has been really well maintained. There's been a lot of CapEx spend by the current owner on interior renovations to a degree that we go a little bit higher than, and we're going to look at during our DD period. But when it comes to the exteriors, the roofs, and some of these other things, those things have been taken care of. And that's some big cost savings in the long-term horizon that we won't have to deal with and we can walk into. And then that's where we see a lot of the CapEx spend that we are reserving is spent on parking lots or on the exteriors of Walnut that need to be brought along. And then we're, you know, expecting to have some remaining CapEx dollars that we can maybe spend on interior renovations down the road.
Yeah, let's jump into that a little bit of how this deal is capitalized. So the total project cost is around just under 17 million, 16.97 million. We're financing 11.96 million of that through bank loans. So that is you know, a LTV of around 72%, loan to cost of just over 70%, 70.5%, and LP equity is making up the remaining 29.5%, or the 5.01 million. On the debt side, the loan carries a 6.85% interest rate with a 24-month interest-only period, followed by a 30-year amort schedule. Year one pro forma DSCR is 1.47x, which gives us meaningful coverage cushion as we execute the rent normalization strategy. And on the uses side, we have 14.7 million goes to acquisition. That's the purchasing price. We have just over 580K in closing costs, 1.375 million to renovation and CapEx, and then just under 95,000 to operating reserves, and 100,000 for our AC fee of the 1.5% purchase price. I also wanted to flag the investment timing on this next slide. For anyone interested in this deal, we'll be going into a couple more details here, but our funding deadline is the 29th of June of this year, with our projected close being the 13th of July. And then we're targeting our first quarterly distribution in 2027. I'll have Chad walk through the unit mix here, as he was the one who reviewed this deal when it came across his desk.
So another good thing is this: these two properties were actually built by the same developer back in the 90s, and then the current owners, as far as we know, bought it from that developer, two very different instances in time over the last 2 decades. And but those allow for the units kind of be similar square footages, as you can kind of see in layouts, building types. So it really does balance well, and the property flows well with the unit mix and how they lay out, and the way the thing was designed with parking lots and everything else. They should have been all together as one property to begin with. And so we're kind of just bringing it back to the same. Unit mix wise, it is basically a balance of 2 and 3 bedroom units. We feel really strongly about that. It's always nice to have a few 1-bedrooms, but as we've seen a lot of our other properties, 2 bedrooms and 3 beds really have a lot of demand, especially in the workforce side. And your rents are staying in those reasonable levels. When you get more urban or inner city and stuff, that's where you see stronger studios, 1-beds. But with this suburban style, having a roommate or 2 or having an office is really beneficial for a lot of people, and that's what's in high demand. And we obviously lean very heavy on the 2 bedrooms, so really feel strongly about that. And you can kind of see from the pictures, but I think the top left is Hazelbriar, and that some of these things have been updated and some of these things have been changed out. And then there's nice LVT floor in a lot of these areas as well, which will be some cost savings on the CapEx.
Yeah, and I kind of want Chad, if you can, we have 3 investment theses. The first one is the rent gap, and I kind of want to put that rent gap into the broader market into context. So we've assembled a comp set of 11 active conventional multifamily communities in the Bloomington MSA. The comp average for the 2-bedroom units is about $1,351. Our current in-place rents of $1,046 to $1,113 sit at the very bottom of that range, below assets that were even built in 1984 and below assets in 1988, and well below properties of near identical vintage. So this is a return to market thesis. The market has already validated these rents. Our job is operational. It's implement professional management, execute on leasing, and treat every renewal as a repricing opportunity. The comps confirm that the market will absorb it. Our second investment thesis is the demand floor. So IU Bloomington is not just like a major employer in the area, it's a structural economic foundation of the city. I mentioned earlier that the fall 2025 enrollment hit a record of just under 49,000 students, and that's the largest incoming class in university history, which means that there's going to be a lot of staff and a lot of other jobs and professional workforce that needs to support that. As Chad mentioned earlier, we are not in a spot where we service the student housing community, but we are close enough to the university to service all of the professionals, the healthcare workers, the manufacturing employees, and potentially even young families, graduate students, the workforce that operates the institutions and the facilities that IU's presence anchors. And so that tenant base tends to turn over less frequently, and it qualifies more reliably, and is far less sensitive to the academic calendar seasonality. Beyond IU, the employer base within 15 minutes of both properties includes the IU Health's Regional Academic Health Center with 5,000 plus regional employees, Cook's Medical World Headquarters with 10,000 plus employees. We have a couple of Novo Nordisk and Simtra Biopharma, which are actively expanding their campuses in Bloomington. And so it sits within a very dense area for a very established workforce. And there are last and one of our more exciting investment theses is the supply constraint. So new conventional multifamily supply in the Bloomington MSA is structurally constrained by the topographic limitations, zoning friction, and the absence of institutional development capital that's targeting this workforce segment. There's also has 0 conventional pipeline approvals delivering through our entire hold period. One thing that I would like Chad Olson to kind of speak to is these vacancy rates and how these relate to part of our strategy with our current vacancy or with our current occupancy rate at the properties being around 97%, which means a conservative 3% vacancy rate currently.
Yeah, it goes to the answering the first one. When you have like a strong occupancy factor like that, it means your rents are probably underpriced and that you probably have room to be able to move those and hit those numbers. And still with a 6% vacancy, you would say that 7% is pretty normal and par for the course, kind of what you see in the national average, which is going to be a little bit higher than that. And all that being said, those encompass all apartments from C and the lower class to the brand new A class. And so they're very all capturing and all consuming. And that's where you can find these different parts in the market where down in Bloomington specifically, and that's kind of what shows in the supply pipeline, it's been a heavy build out of A class or student apartments. Those have been the 2 bifurcations that we've seen in the marketplace. And the student definitely saw some occupancy stuff or occupancy decline because of all the supply that came on board and because of their seasonality and because they have to all move in, by July and August. And then the A-class side of things, there's just been a lot of it that's been built. There's a big gap in the workforce side that we are coming to fill. And so by providing quality housing, improving those properties and being one of the nicer workforce deals in the area, it should be a really strong point for competition in the space, maintain our occupancy at a pretty reasonable level. We have that cushion built into the model at the average, and then be able to move those rents up.
Yeah, and so this market it has a lot of economic momentum. I think that to put this into kind of a more visual perspective, here's where Bloomington Collection sits, and then all those anchors, market anchors that we had spoken to earlier, sit within those areas. We have anywhere between 12 to 15 minutes. We have some 5 minutes areas in the schools, and then you have some good retail use. Chad, can you speak a little bit more to why this location is so valuable, given the market anchors that are currently there?
Yeah, it's an easy drive time. It's even though you can kind of see it removed from the 69 side, there's an exit kind of just north of it. So it's very easy access and an easy drive from over to that side. There's a bus system that runs through the area that can still get you to campus if you're wanting to go to that direction. You're supported by kind of the major grocers and everything else, but it comes down, and then it's hard to see on this map, but there is kind of a major north-south route that runs through there, and there's some car dealerships that are nearby our site. That is Old 37, so that's one of the major thoroughfares through the entire thing. So access to all the surrounding areas is quite easy without being surrounded or inside the campus and all what goes on there with the student life. And being able to access all your major employers and everything else.
Yeah. We kind of already touched on this, the comp set in the context of the rental gap thesis, but we kind of wanted to show a little bit more detail here. On the 2-bedroom side, our in-place blended rent, it sits at $1,065 on the far left of the chart. And where our comp average is at $1,351. Post renovation, our underwritten 2-bedroom bedroom rent is going to be around $1,259, which moves us into the middle range, above a lot of the lower comp areas, but still below some of the newer products. So it's a very conservative target supported by the market, and you can kind of see where that move would go post renovation. Still sitting at that average, still sitting below the comp averages, but a healthy increase in rents. And then on the 3-bedroom side, the picture is pretty similar. Our in-place rents are between $1,157 to we're going to be moving them to $1,414, which would place us at the low end of the comp set. Again, post renovation, we're underwriting to the $1,286 on a blended 3-bedroom. Again, going up to the $1,473. And so the key takeaway here is that we're not projecting to become the most expensive option in the market. We're projecting to stop being the cheapest, which is a very achievable bar. And then just to give it a visual comparison on where we sit geographically to a lot of these other rent comparables, we're in a pretty constrained market already, but we are still anchored by all those local employers. So we're going to hop straight into our business plan. Chad want to talk about a little bit about how Bloomington Collection is going to be stabilizing cash flowing asset from day one.
Yeah, so it's coming in and spending most of the time on those rent gaps and really moving the needle on that. With when we close relative to the prime leasing season, we should be able to capture that and start the momentum. But taking that top line revenue and increasing it, right? That's number one. Doing that value and providing that value, as we've had experience with other value add deals, is coming in as soon as possible and changing and adding capital expenditures and showing the residents that we're there and we're coming here not just to raise rents, but to raise the asset overall, right? And so we have our plan on CapEx that we're going to be validating actually tomorrow when we go into our due diligence date. and figuring out exactly what we want to do and what we're going to spend on and everything else like that, more firm. But right now the plan is to spend money on, windows, exterior CapEx, common area revitalization, and then some deferred maintenance that we find on that stuff. And then if we have leftover dollars, then looking at some unit renovations and everything else. Walnut is a little bit more dated than Hazel, so we'll look at those strategically on what we want to add value to is in there. The next thing is kind of getting into the other income. So we will, with Walnut and with that property manager, they have implemented some of these, whether it be a proficient rub system or pet fees, trash fees, some of these other fees, common area maintenance, and those kind of protocols. That isn't being applied on Hazel because of the management style of that manager. So we're going to be able to apply those and then bring both of them up. So that's going to be some other income drivers. And then we get to below the line or below income into an expense side of things, and talking back to bringing two smaller properties together and providing management efficiencies across both with a proficient property manager. That's another big driver where we're going to see some expense reductions. We've gotten some really good insurance quotes preliminary because of the 90s vintage. That helps a lot. And so we're going to be able to bring in insurance inside of where the current properties are sitting at least one of them. So we'll see some cost savings there as well. And so all those things combined move that cap rate above where we should be coming in on, move that cap rate on our in-place thing, moving towards stabilization or stabilized cap rate above our debt. And that's where the cash flow starts to come off.
Chad, walk us through our next two slides are the financial overview of the assumptions, and then right after this slide on slide 22 is the pro forma. Can you walk through some of the operating assumptions underlying the pro forma?
Yeah. So you see this kind of breakdown of expenses broken down by per unit. These expenses are coming off of our experience currently with our other properties that we're dealing with this property management company specifically with their input. And then some of them just taken from the actual property level. So payroll being one of those expenses. We're running a similar size property around this price per unit. We would hopefully be able to bring it in. We would expect, but this should be more than enough. What we're seeing in other properties. Taxes are just based off where we saw last year and this year's assessed values. We have it built in and have gotten a third-party tax analysis to confirm that. R&M contract services, kind of same story with what we're seeing at other properties and what we're seeing from this property management company. Management fees negotiated with the PM company. Insurance, kind of what I discussed with already getting a pretty solid quote, and that should be the ballpark that we end up striking in. Make ready, A&M, G&A, very similar story. Utilities, I'd like to probably highlight a little bit more. Those are quite low. And that's because of a lot of the individual metering that's done at most of these units and properties. And that'll help us reduce some, but there is still some shared costs that we're going to be able to get back, or that's got the vacancy that we're hopefully going to maintain. And then the CapEx reserves are generally lender required, but we like to do it anyway, even if it wasn't. And we reserve $250 per unit per year into a fund that we can then deploy later if certain CapEx needs arise. That being said, we do have CapEx reserves that we're bringing on from the beginning that are in total up into our development budget or renovation budget that we've shown and construction costs. And then we also have an operating reserves that we hold going into the property for generally about 1.5 to 2.5 months. And I think on this one, we have 1.5 months reserved. But we've seen that pretty consistent across our properties. Where we've had more than enough cash to operate them from day one.
Mm-hmm. And then our pro forma for the 5-year hold.
Yeah, I mean, kind of what you see with the expenses that we just kind of went over, that makes up the total operating expenses, and then income's driven from current in-place property, and then moving those rents up. And then we have our growth rates that are kind of shown at the bottom that factor into those year over year till we get to our exit in year 5. And that's kind of how the pro forma works.
Yeah, I think that the story here beyond the numbers is that the trajectory from here is pretty consistent and supported by our conservative growth assumptions, the stuff that Chad just addressed. And because of that, when we drive the rent normalization and the modest market growth, everything tends to go up from there. Now let's go to what investors are most interested in. Typically, in my seat of IR is what do you get out of the deal? So on a 5-year hold at an expected 6.5% exit cap rate, the projected LP returns are as follows. So we kind of touched on this in the very beginning: 16.8% IRR, a 2.07x equity multiple, and a 6.01 ish. A little bit over that average cash on cash return. There's an 8% LP preferred return as of all of our deals, and then our average annual return is 21.4%. So to make this more tangible, to break it down, let's look at the minimum commitment of $200,000, which represents approximately just under 4% ownership stake in the offering. Year one distributions are going to be just under $7,100, as we're early in the rent normalization period, and the interest-only period is funding initial operations. Year two will jump to 13,738 as rents close toward market and NOI grows meaningfully. Year three distributions are at 10,382. Year four is at 12,475, and year five, which also includes the sale proceeds, distributes $371,286. So the total return from the sample investment return on invested capital will be $214,958. So just under $215K. And your total return plus your original capital will be just around $415K. The waterfall structure is an 8% LP preferred return first, then a return of capital, then an 80-20 LP GP split until investors achieve a 17% IRR, and then we're at 50-50 thereafter. Another important note is that as with all of our deals, the GP will co-invest at a 5+% rate, so we're in this alongside you. One thing to clarify on the LP preferred return, this will be included in our operating agreement. This is non-compounding, but it is cumulative. With our sensitivity analysis, as Chad does with all of our deals, we've stress tested the returns across a range of exit cap rate scenarios. So our base case assumes that 6.5% exit cap rate, consistent with the current transactional activity for comparable 1990s vintage Class B multifamily in Indiana. And that produces that 16.8% IRR and that 2.07 equity multiple that we just discussed. In an optimistic scenario at a 6.25 cap rate, the LPI IRR improves to 18.3% with a 2.2x multiple. In a modest scenario, we're at 6.75, returns compressed to a 15.3% IRR and a 1.94x equity multiple. And then in a conservative scenario at a 7% exit cap, a 50 basis point compression from our base case. The LP IRR is at 13.8% with a 1.83x equity multiple. So even in the most conservative scenario modeled, investors are still achieving a double-digit return and getting more than their capital back. And we believe that the base case at 6.5% is well supported by current market conditions, but we think it's important that you can also see the range. One thing that I wanted to jump into, Chad, if you could kind of approach how our risk disclosure is we look at all the risk as a part of a discipline and not a formality, and every deal has risk factors. And what matters most for our investors is whether you understand them and how we understand them and how we are mitigating against them. So Chad, would you be able to jump into kind of some of our risk considerations when it comes to this deal?
Yeah. So laying it out, we have kind of the IE funding compression and headcount reduction, which kind of goes really to speaking about employment gains or decreases inside of a marketplace. IU just won a state champion, go Hoosiers, or a national champion, go Hoosiers. So we'll hopefully run it back again this year. But you have record IU enrollment, as you kind of laid out there, one of the strongest first-year classes. You have some other ones that are expanding their investment into the area. And there will be more investment that comes. Indiana's done a lot of investment into these major thoroughfares on 69 and 65, respectively. And we're going to see continued growth in these major kind of areas. IU being in Bloomington and compared to Purdue and Lafayette, we're seeing a lot of investment into both of those marketplaces and think that will continue. And most of the time what you see with those spreads is like A-class chasing it or some of this other stuff. There's always a need and demand for quality workforce housing in any given market, and we can't build new stuff like that. So we know that, and that kind of goes into the next point, which is supply pipeline. We kind of laid out what that looks like. It isn't like some of the other markets that we've gone to operate in and purchased in and will continue to purchase in. When we can find those opportunities that are in high supply markets, but get them for a really good basis because of that, and then ride that storm through with the right reserves, the right operating principles, and everything else, we're gonna take advantage of those. But this one, like I said, there just hasn't been a lot of investment in the workforce housing. We know of a few distressed assets and portfolios in the market that just a lot of out of state investors piled into and have not been operating very strongly at all. And so there's actually been a decline, I would argue, in workforce housing, especially quality workforce housing provided in the area. And people will not go to those apartment complexes, even though they're in good areas and by all intents and purposes good properties, but they're just not run and managed well, and the capital is not being spent on them to take care of their residents. So pipeline seems really strong. The student, I think this year will get absorbed, but it just was last year that it really felt that just because it came on all at once. I think wage growth, as we were kind of talking about, goes to the first point that there's going to be continued investment. There's continued growth down there in specific sectors, even though you see some that are pulling back. I think that's a story of the U.S. economy in general. And then insurance cost. When it comes to insurance cost, we saw a pretty large run up in 22, 23, and 24, especially. 25 and now 26, we're seeing it level off and come down. So I would say 25 was the year of it leveling off. 26 is the year of it coming down. We're seeing insurance providers be very competitive. They're still very selective in which insurance carriers are doing which kind of deals, but there is some competition between them, and we benefited from it. And then to that point, Indiana and the Midwest, which is a big reason that we're very interested in investing in them, insurance costs are considerably lower than what you see in a Florida, a Texas, a California, or any of the other coastal areas. And sure, we have tornado risk and some of these other things, but that's generally mitigated just because it's rather infrequent. There's certain areas that are more susceptible to them, but it's rather infrequent. And then being the quality of buildings that these are should hold up to a lot of conditions, but we carry the proper insurance to be able to mitigate that risk and carry the right deductible and everything else and have the right good contract relationships in case an issue like that came up. But because of that, we're going to be well inside of that $500 a unit, and that gives us a considerable margin for error that even if we were to experience some insurance inflation on premiums, we would still have plenty of room and still be able to hit our numbers and cash flow on this deal.
Thanks, Chad. To round us out, kind of expanding on what Chad Sheeler had said about us earlier, just kind of giving you a little bit of introduction to the team. You've learned more about the asset, what went into kind of underwriting this, what you'll be seeing as an investor when it comes to returns perspective, but really who's the team behind your investment. So here at Focus Capital was founded on a patient and conservative approach to multifamily real estate private equity. And as you can see here, our priority is capital preservation. So we are targeting delivering steady risk-adjusted returns with a focus on consistent cash flow. Our team includes Chad Sheeler, who you met earlier in this call. He's our founder and principal. Myself, Jared Shum, I'm head of investor relations here, and I run the capital formation efforts. Front and center, we have our poster boy, Chad Olson, VP of investments here, definitely adding to our pretty card here. And then Andy Kropp is our director of asset management, has a background with Bergen Held, which is the property management company that we'll be working with on both of these properties. And then Tracy Mundell is our executive assistant here, and you may be receiving communications from her as your investment journey with us continues to expand. So we're a focused, experienced team, and this offering reflects that same disciplined approach that we bring to every single acquisition. Our track record as a firm kind of speaks to our ability to execute. On the full cycle side, we've closed 4 realized investments, and we're at an average IRR of 44.18% on that, with an average equity multiple of 2.10x. On our current portfolio side, we have 7 active assets projecting IRRs ranging from 15 to 19%. We have Gateway Crossing and Heritage Square, District South, Autumn Trace, Elston Point, Melrose Place, and Atlas Apartments. Bloomington Collection, after we close this July, will be our 8th active asset. And so we have a consistent history of delivering for our investors, and we intend for Bloomington Collection to be no different. Kind of wrapping up here. Next steps. So to close, here's where we stand on timing. Again, just a quick reminder, our funding deadline is the 29th of June with a targeted close on the 13th of July. Our first distribution is projected for Q1 of 2027, and our target exit is around year 5, so estimated 2030 or 2031. If you have any additional questions, you can view the full offering details via the link in the description. We'll put both the executive overview deck and the institutional deck, which is what we just ran through, in the links below. And if you have any additional questions on the offering details itself, or would like to review the paperwork, our PPM, our OA, our subscription agreement, that'll be via the investor portal link that will also be in the description below and is on this slide if you just scan those QR codes. If you'd like to schedule a call with our team to discuss anything further, you can scan the QR code on the screen, but that link will also be included in the description below. One other note is that this offering is only open to accredited investors under Regulation D 506C. So please review the full PPM before making any investment decisions. And on behalf of myself, Chad Sheeler and Chad Olson, and the rest of the Focus Capital team, thanks for your time and your continued trust. And we're excited about this one. And we look forward to having everyone involved. Thanks, Chad, and thank you everyone else for your time.